It has officially begun. The signal we have been waiting for, the signal that separates a correction from a collapse, just flashed across the terminal. If you're looking at the price of silver at $84, you are looking at the headline, but you are missing the story. The real story isn't the price, the real story is the vault. We have just received the preliminary data from the COMEX warehouse reports. And the numbers are not just bad, they are catastrophic for the bullion banks. In the last 24 hours, following the close at $84, a staggering 2.9 million ounces of silver has been removed from the registered category. It didn't just move to eligible. It didn't just shuffle from one bank to another. It vanished. It was loaded out. That means it physically left the building. It was put on a truck, surrounded by armed guards, and driven away from the exchange forever. To put 2.9 million ounces into perspective, that is roughly 90 metric tons of silver. That is the equivalent of the entire monthly output of a major primary silver mine, gone in a single trading session. Why does this matter? Because registered silver is the only silver that is actually available for delivery against a futures contract. It is the inventory on the shelf. Before today, the registered category was already sitting at multi-decade lows. The shelves were already bare. This 2.9 million ounce withdrawal is like someone walking into a grocery store during a famine and buying the last 100 cans of soup. The banks know this. That is why we saw the desperate attempt to cap the price at $83 yesterday. They threw paper contracts at the market, trying to paint the tape, trying to scare you out. But the whale who took delivery didn't care about the paper price. They stood for delivery. They slammed the buy button and demanded the physical metal. This is the run on the bank we have been warning you about. It isn't happening at your local branch with dollar bills. It is happening at the bullion depositories in New York with 1,000-ounce bars. The confidence in the paper derivative system has snapped. The smart money, the entities with deep pockets and inside intel, is cashing out of the casino. They are taking their chips off the table and trading them for hard assets. The timing is surgical. They waited for the $84 breakout. They waited for the technical confirmation that the bear market was dead. And then they struck. This isn't retail buying coins. This isn't your neighbor buying a tube of Eagles. This is a sovereign-sized entity draining the liquidity of the West. The run has begun. The 2.9 million ounces is just the first domino. When the other deposit holders see this data, when they realize the vault is draining at a rate that cannot be sustained, the panic will not be to sell. The panic will be to withdraw. We are witnessing the beginning of the end of the COMEX as a price-setting mechanism. The physical reality is asserting itself. $84 is not the top. $84 is the starting gun. Part 2, the $84 trigger and the gamma wall. To understand why $84 was the trigger for this 2.9 million ounce drainage, you have to understand the gamma wall. We have talked about this before, but today we crashed right through it. The options market is a minefield. Market makers, the banks who facilitate trade, sell call options to speculators. These options give the buyer the right to buy silver at a certain price. For months, the strike price of $80 and $80 was the ceiling. The banks sold millions of ounces worth of calls at these levels, collecting the premiums, convinced that silver would never get there. They were picking up pennies in front of a steamroller. Yesterday, the steamroller arrived. When silver closed at $84, those options went in the money, deep in the money. This forces the market makers to hedge. They are contractually obligated to deliver silver they do not have. So, what do? They have to buy futures contracts. They have to go into the market and buy. This creates a gamma squeeze. It is a self-reinforcing loop. The higher the price goes, the more they have to buy. The more they buy, the higher the price goes. It is a mathematical feedback loop that defies gravity. The 2.9 million ounce withdrawal we just witnessed was likely a desperate scramble by a trapped commercial entity to secure physical metal to cover a naked position. They were caught short. They were naked. And now they are paying the price. But there is a deeper layer to this $84 close. It broke the psychological Maginot line. For 3 years, every time silver poked its head above $30, it got smashed. Then $50, then $75. The market was conditioned to sell the rips. Traders were trained like Pavlov's dogs to short every rally. $84 broke that conditioning. It proved that the bank smash no longer works. We saw them try to smash it at $80. We saw the red candles. We saw the algorithm dump 5,000 contracts in a minute. And what happened? The price didn't collapse. It bounced. It ate the supply. It rallied harder. This failure of the suppression algorithm is the most bullish signal in 40 years. It means the Fed put is gone. The JP Morgan put is gone. The market is now free. And a free silver market is a terrifying thing for a central banker because it tells the truth about the currency. The withdrawal of 2.9 million ounces tells us that the commercials are starting to cannibalize each other. Usually the banks work together. They operate as a cartel to manage the price. But when the vault runs dry, there is no honor among thieves. It becomes every bank for itself. I need my metal. I don't care if you fail. I am taking my 2.9 million ounces and leaving. We are seeing the fracture of the cartel. The $84 close was the hammer that cracked the dam. The water is pouring through, and the water is physical silver leaving the system. The paper price is just trying to keep up with the physical reality. Part 3. The identity of the whale. Who took the silver? This is the billion-dollar question. 2.9 million ounces does not disappear into a private basement. This was a strategic acquisition. We have 3 primary suspects, and any one of them guarantees that silver is heading to triple digits. Suspect number 1, the solar giant. We know that the Chinese solar industry is in a state of panic. We covered the just-in-case inventory shift in our last dossier. The TOPCon solar cells require 50% more silver than the old technology. Production targets for 2026 have just been increased by Beijing. It is highly probable that a conglomerate like LONGi Green Energy or Jinko Solar, acting through a proxy in London, just secured a month's supply of paste material. They don't care about the price, they care about survival. If this was industrial buying, that metal is going into a furnace. It is being consumed. It is gone forever. Suspect number 1, the sovereign stack. Look at the BRICS nations. Look at India. India's silver imports hit a 38-year high recently. They are reclassifying silver as a strategic reserve asset alongside gold. The Reserve Bank of India or the People's Bank of China could easily be the entity behind this withdrawal. They are moving out of dollars and into hard assets. They see the U.S. debt spiral, $36 trillion and counting, and they are swapping their paper IOUs for physical collateral. If this is sovereign buying, that metal is going into a deep storage vault to back a new currency unit. It is never coming back to the market. Suspect number 3, the tech insider. This is the wild card. We have heard rumors of a major tech company, possibly involved in AI hardware or solid-state batteries, realizing that their supply chain is vulnerable. Samsung, Apple, Tesla. These companies sit on billions of cash. For them, dropping $250 million to secure 2.9 million ounces of silver is a rounding error. It is pocket change. But that pocket change just broke the global pricing mechanism. Regardless of who it is, the why is the same. Shortage. They know what we know. They know about the deficit. They know that mining production is flat while demand is exponential. They know that the above-ground stockpiles are being drawn down. We are seeing a phenomenon called backwardation intensifying. This is when the spot price, the price for metal right now, is higher than the futures price, the price for metal next month. This should not happen in a healthy market. It costs money to store silver, so future silver should be more expensive. When spot is more expensive, it screams, "I want it now." The market is saying, "I do not trust your promise to deliver in March. I want the metal in my truck today." The 2.9 million ounce loadout is the ultimate proof of backwardation. It is the market rejecting the paper promise. This whale has ripped a hole in the inventory that cannot be patched. The miners cannot ramp up production fast enough. It takes 10 years to build a new mine. We don't have 10 years. We have 10 days before the next delivery cycle. The squeeze is structural, it is physical, and it is accelerating. Part 4, the unobtainium phase and the supply snap. Let's visualize what happens next. The 2.9 million ounce withdrawal is the rock thrown into the pond. The ripples are about to hit the shoreline, and the shoreline is the retail supply chain. We are entering the unobtainium phase. You need to understand how the supply chain works. It is a just-in-time system. The local coin shop orders from the wholesaler. The wholesaler orders from the refiner. The refiner orders from the COMEX or the mines. When a whale takes 2.9 million ounces out of the COMEX, they are draining the reservoir that feeds the refiners. By next week, I predict we will see the following sequence of events. Refinery delays. The major refiners in Switzerland and North America will announce extended delivery times. They will claim it is due to high demand, but the truth is they cannot source the raw 1,000-ounce bars to melt down. Wholesaler rationing. The big distributors will stop taking orders for large quantities. You want 1 monster box? Fine. You want 10? Sorry, we have a limit of 1 per customer. This is rationing. It is the hallmark of a broken market. The premium explosion. The spot price might be $84, but try to find a Silver Eagle for less than $110. The disconnect will widen. The paper price will trail the physical price. You will see a black market emerge where the real price is discovered in cash, off the books, far above the COMEX ticker. We have seen this movie before. We saw it with palladium. We saw it with rhodium. The price goes vertical and the metal disappears. Imagine trying to buy silver when the price is moving $5 or $10 a day. Dealers will not lock in your price. They will sell to you price at time of shipping. You're buying a blind ticket. And critically, the force majeure clauses are being dusted off. Every bullion dealer has fine print that says they can cancel your order if market conditions make delivery impossible. We are inches away from mass cancellations. Imagine buying at $84, watching the price go to $100, and then getting an email saying, "Sorry, order canceled. Here's your refund." You get your worthless dollars back, but you miss the wealth transfer. This 2.9 million ounce withdrawal has effectively snapped the elasticity of the supply chain. There's no buffer left. If another whale comes in tomorrow, if a pension fund decides to allocate just 0.5% to silver, there's no metal to give them. The authorized participants of the silver ETFs, like SLV, are the ones who usually source this metal. They are now competing with the whales. They are looking at the same empty vault. This leads to the paper trap. The ETF might trade at a discount to the metal because investors realize the ETF does not actually have the silver it claims to have. You must be positioned before the sold out sign goes up, because once it goes up, it stays up. Part 5, the minor pivot and the ratio play. So the physical market is locking up. The paper market is squeezing. What is the play? How do we navigate this chaos? We have to execute the minor pivot. While the physical metal is the safety net, the mining stocks are the leverage. For the last decade, silver miners have been dead money. They have been crushed by rising energy costs and suppressed silver prices. They were priced for bankruptcy. But at $84 silver, the math changes instantly. Most miners have an all-in sustaining cost, AISC, of around $20 to $22 per ounce. At $25 silver, they made $3 profit. At $84 silver, they are making $62 profit per ounce. That is a 2,000% increase in free cash flow. The stock market has not priced this in yet. The algorithms are still underweight the sector. But when the Q1 earnings reports start leaking, when these companies announce dividends that are higher than their stock price used to be, the capital will flood in. We are talking about a sector rotation of biblical proportions. Money will flee the overvalued tech stocks, the Magnificent Seven, and pour into the real assets. But you must be careful. You must avoid the miners who hedged. Some foolish CEOs sold their future production at $30 to survive the bear market. They are doomed. You want the unhedged producers, the ones who have full exposure to the spot price. And then we have to talk about the exit strategy. Do not fall in love with the paper profits. We are not stacking silver to get more dollars. We are stacking silver to preserve purchasing power. The goal is not to sell for fiat. The goal is to swap for real assets. Watch the gold to silver ratio. Right now, with gold at $4,500 and silver at $84, the ratio is roughly 53:1. It is dropping fast. When it hits 30.1, you start paying attention. When it hits 15:1, you swap. At 15:1, silver is historically expensive relative to gold. That is, when you trade your volatile silver stack for the stability of gold. You lock in your gains. You effectively triple your gold holding without spending a dime. Or you swap for land. You swap for income-producing real estate. The end game is not a high bank balance. The end game is owning the means of production. This 2.9 million ounce withdrawal accelerates the timeline. We thought we had until 2027. We might be looking at the climax of this move in late 2026. The velocity of money is picking up. The velocity of silver leaving the vault is the leading indicator. Part 6, the final verdict. We have dissected the data. The 2.9 million ounce withdrawal is real. The $84 breakout is real. The supply chain fracture is real. So here is the final verdict. The era of cheap silver is dead. You will never see $25 silver again. You will likely never see $50 silver again. We have crossed the event horizon. The banks have lost control. The paper shorts are currently staring at a multi-billion-dollar loss that they cannot cover. Expect extreme volatility in the coming days. They will try to spoof the price down. They will launch margin raids to try and shake you out. They will release hit pieces in the media calling silver a bubble. Do not listen. Look at the vault data. Look at the 2.9 million ounces that just left the building. That is the truth. Everything else is noise. If you're holding physical silver, you are holding the battery of the future and the money of the past. You're sitting on the right side of history. Do not let them scare you into selling early. Do not let them trick you into swapping your hard asset for their dying currency. The transfer of wealth is happening right now. It is flowing from the paper hands to the diamond hands, from the blind to the awake. The run has begun. The vault is draining. The clock is ticking. Hold the line. Subscribe to the channel because we are tracking the vault movements daily. The next withdrawal could be the one that empties the room. You do not want to miss that update. Stay liquid, stay physical, stay dangerous. Class dismissed.